Who knew it would happen so soon? We are rapidly revisiting Rivian on the basis of the announcement that the company made earlier this week, but after the video we did on Monday. We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. So earlier this week I was talking about Rivian. What was I talking about? I was talking about the R2 on my screen right now. Or no, that's not on my screen right now. This is an article from Barron's about the R2. This is why it had gotten an upgrade. This article came out in March. You may find this interesting though. We were given an update on the order that my wife placed for the one that she ordered. And apparently she cannot even formalize the spec for that vehicle until sometime between December and February, which suggests that the demand for these things is quite high. And my guess has been significantly underestimated by the street. That is the good news. The bad news is something which I talked about on Monday, which I anticipated was that the company was going to need to do a capital raise. Indeed, they announced shortly thereafter that they were going to do a capital raise. I suggested at the time that that capital raise should come in the form of a secondary rather than issuing additional debt, as that would give management more flexibility. And indeed, that is what management did. They said they are going to issue 75 million shares. That amount is equivalent to roughly, in round numbers, about 1 quarter's worth of cash flow burn. One would have imagined that, number one, other investors would have anticipated this. Number two, that an additional bit of runway might have been a little bit of an offset to the dilutive effects. 75 million shares is about 6% of the 1.25 billion shares currently outstanding. And instead, the stock sold off by about 18%, which suggests 2 follow-on offerings of comparable size, if you think about it from a dilutive respect, and no net benefit for what that cash would do in terms of increasing the company's operating flexibility. I think it is also quite clear that once this offering is complete, the company is going to have sufficient cash for investors, car buyers, everybody, frankly, to see whether the R2 is a success or not. My guess, as it was before, is and remains that it will be a success. Volatility remains bid. They are going to be announcing earnings at the end of the month, although I don't really think that's the story. I think this product is really the story. And I think this still means that selling some premium on Rivian makes some sense. Now, I reached out to my friend and fellow CNBC contributor, Carter Worth. The reason I reached out to him is because I wanted to see what he thought about the fact that the stock seems to have come back to and probably closed on or about the 150-day moving average. That's not the one I want right there. So I went into the wrong thing. This is what I want right here, 150-day moving average. And you can see that basically it got down to this level. And in fact, it actually did trade slightly through this level, but ended up closing slightly higher. But this is the 150-day moving average. He described this as a, quote, pair of twos, which, if you're going to sell premium, is kind of what you want. And if actions speak louder than words, that's when it begins to make some sense that he is actually himself short strangles in Rivian, something you can see because he runs an actively managed options income fund called Worth, WRTH, and he is short. Oops, that was well done. He is short. Is that gonna, as you can see here, to draw a box. Let's see, there we go. He's short 1,000 strangles in this thing. This 1,000 lot, by the way, just so you know, it's basically a worthless upside call, but it's not worthless in the context of a RIC, a registered investment company, which cannot be naked short upside. So What they do is they will identify a strangle that they want to be short, and then they can buy an upside call to protect against, you know, a big rip to the upside. I don't know that many of the companies that they would typically be trading have the possibility of a big rip to the upside. What would things like that be? Well, arguably the biggest potential cause of something ripping higher would be a short squeeze. This does have a decent percentage of the float short, which, as many will know, can create a little bit of a bid or support for a stock as people who are short seek to cover. It also can create some significant short-term rallies as people get squeezed. So according to the S&P, they have a scale that runs from 1 to 3. 3 is a high short squeeze risk, 1 is not, 2 is kind of right in the middle. The S3 score of 88, though, is getting slightly elevated. So if you are interested in engaging in a strategy similar to the one that Worth did, if you have not already effected a trade in this, not that, I'm trying to go to this. That's what's going to go into options play. What a trade like that might look like. You would, this is sometimes called a jade lizard, by the way, if you're unfamiliar with the strategy. So jade lizard is a situation where you sell, we're going to do this, sell a downside put, maybe you sell an upside call, and I'll try to find something that's maybe 1 standard deviation out of the money, like that. And then you buy a further out of the money call to hedge that upside potential tail risk, right? So might look a little something like that. You don't really see it in this, but that's just so that you're not taking the naked short risk. You collect most of the money in between the 2 short strikes. You can see that the break even in this case on the upside would be, and this is out to August, would be up and around, what price are we looking at here? $22 and change, $22.73. We've got the break even right here, $22.32. So upside break even of $22.32, downside break in of $13.68, standstill rate of return of $1.32 over the course of this short period of time. But I still think selling premium in Rivian is an interesting opportunity. I still believe that the R2 is probably going to sell better than many people have priced in to this stock. And I think it's important for us just to refresh our memories on, why it is that stocks trade off on secondaries and what would be an appropriate level, right? So as I pointed out here, they needed to raise capital. If you are a shareholder, the market cap right now at $21 billion, as you can see, the shares outstanding, 1.2565 billion, right? So 75 million shares over 1256.5 is 5.97%. So even if that offering did not put any money into the coffers of Rivian, a shareholder of Rivian, once the offering takes place, which it has not yet, would only own 5.97% less of the company than they did prior. And the company, obviously you want to bake in that offering as well, would have an extra $1 billion in the kitty, in and around these current prices. I mean, let's just assume they get it off at $15. How about that? So that's 1.125 billion of additional cash, quarter's worth of needed cash. So, bringing the stock in by 18.5% does not make a whole heck of a lot of sense to me. Here's something else that I think is kind of interesting, and that is that when I discussed it as a strategy, I was talking about the August 16 puts at the time. And let's just take a look at the August 16 puts, where they are, because if you'll remember, the mid-market price on those August 16 puts was, at the time I discussed it, 89 cents. And I suggested even a sale of 85 cents. And what you're going to see here is that these have gone up in price by, well, they're $1.32 to the mid, right? So that's up 43 cents versus the midpoint when we talked about it on Monday. The stock, meanwhile, was down $3.65 yesterday. So you begin to appreciate that while you are taking the risk that you own the stock and own it at a significantly lower level, that relative to the risk you're taking by buying the stock here in terms of your day-to-day volatility, it still is going to be considerably less. So something to think about. I just felt compelled to bring this up because I'm at a loss. How could investors not have anticipated this? But, based on an 18% pullback, clearly they didn't. They are not apparently looking at the pro formas. They are not seeing that the company's going through a little over $1 billion a quarter. Of course they were going to do a raise. And anyway, interesting stuff. I continue to be interested in it. Okay. Ranjana Gupta. Hi, Mike. I watched your video on synthetics. 2 thumbs up. Okay, thank you. I have a small account, so I can't sell cash-secured puts on stocks like Lilly and Broadcom. Would synthetic longs on these work for me? So synthetics... So in order to... Yeah, if you can't sell a cash-secured put on Lilly or Broadcom, a synthetic involves selling puts, so you're not going to be able to do that. Could you do something like sell put spreads? I suppose, but bear in mind that selling put spreads, even though the capital requirements might be less, don't necessarily have a whole lot less risk than selling a cash-secured put would. And this might not seem intuitive to a lot of folks, but here's the way to think about it. If you sell a put, then you are taking the risk that you're going to own the stock at that strike price, less the premium that you spent. And if you buy it further out of the money put, so let's say you just bought the stock and bought a downside put, you could limit your risk. But the truth is that the probability that the stock declines by a small amount is significantly greater than the probability that the stock declines by a large amount over some discrete window of time. Let's use Broadcom as an example. So what I mean by this is that if you look at this distribution, and let's just pick a oh, what the heck? We're going to go, so this is just over 1 day, but why don't we just look out till the end of next week, let's say. So here we are, it's Wednesday. We've got nine days until, and I believe the periodicity here is actually in trading days, so we're just going to say that's a 7. So what does a 7 trading day window look like? And basically, if you sold a downside put, let's say you sold a 5% out of the money put, that's going to be in here. And then you bought a 10% out of the money put, that would be down here. What you're going to find is that the insurance that this provides is really just against everything that's over here. Can these events take place? They can. Have they? They have. Do they happen with great regularity? Not really. And what that tells us, I'll expand this out a little bit more so we can look at this in somewhat greater detail. So when you sell a put spread, and maybe this, this 5%, 10% put spread that I was just talking about. So it looks like there's probably some edge in a trade like that, but the hedging mechanism that you're getting from this is not so significant. And basically, that's really the only difference. So somebody with a small account can sell that put spread, and maybe they can't just sell this put naked. But it's only in a handful of circumstances where that short put spread would actually really save you any money. And in most circumstances, all in here, so everything to the right of the put strike, you actually would have made more money by just simply being short the naked put. A synthetic involves selling a put and buying a call of the same strike and expiration. So customer portfolio margin account, Reg T account, almost doesn't matter. If you're not able to buy the stock, you're probably not going to be able to trade the synthetic either. That's not like a remarkable savings. One thing you can do, and we've talked about this before, is buy an in-the-money call spread with no extrinsic premium to make your directional bets. But again, the hazard I find when people start trading high dollar stocks with options is that if you're capital constrained, you might end up taking on a bigger position than you would if all you were doing was buying the stock. And what I mean by that is, let's just say you had $50,000 in an account, and you thought that an appropriate number of constituent stocks in your account was 25. That gets you most of the benefits of diversification. Let's assume that they were spread around. And so that means you want 2.5% in each stock. Well, if you wanted 2.5% of a $50,000 book in Broadcom, that would be $1,250. And $1,250 of a $389 stock is just over 3 shares. Well, you can't trade 3.2 shares in options contract land because each options contract represents 100 shares. Now, can you take $1,250 worth of risk trading Broadcom options? Sure you can. But is it going to behave like a $1,250 position in the underlying equity would? It will not. It's going to be significantly more levered. So let's find an example of a Broadcom trade where it's going. Let's do this, a little bit more concretely. So I'll do this. So we're going to put in Broadcom here, and I'm going to build a couple positions, each to the tune of about $1,250 or $1,200. So this, I'm going to just take this down. There. So 3 shares, $1,162. I can buy a short dated call option. I'll just go out to July regular way expiration. This is July regular way expiration. And I'm going to buy a call option for about the same amount of money, $392.5. All right, so this is $1,148. This is $1,162. Right? Now we can trade a call spread, and I'll try to do that for a similar amount of money. So, and we'll spread this one out a little bit further on the calendar. So I can do a 380. Let's see, 380. Let's go to 400. Keep the math easy. We'll choose the 400. Oops. Thought I chose the 400. Picked the wrong one here. So 400. 410 call spread. Okay. So that's $417, and we're going to bump the quantity up. There we go. All right. So now we have 3 trades. Each of these trades is near to 2.5% of a $50,000 portfolio. $1,162 worth of stock, a $1,148 call, and 3 call spreads that cost about $1,250. Do these things all risk the same amount of capital? Well, in a way they do. If the stock goes to 0, these will all lose very comparable amounts of money. If Broadcom goes to 0 and you own $1,160 of it, you lose all your money. And if you bought a call, same thing, you lose all your money. You bought a call spread, you lose all your money. But the likelihood that Broadcom is going to go to 0 between now and September expiration or July expiration is very, very small. Now, the chances that it loses 10% of its value between now and then, that's a very realistic possibility. And if it loses 10% of its value, this trade will lose 10% of $1,162. You'll lose $116. These other two trades lose it all. So a 10% decline, you lose $116 in this trade. 10% decline between now and July expiration, you use $1,148 in that trade. And a 10% decline between, at September expiration, and you lose $1,250 in this one. All required the same amount of capital fully paid, but the risk is not the same. And so this is one of the things that I have seen happen to people who start trading options, which is that they think, oh, well, I can control a much bigger portion of the stock for the same amount of capital. Yes, you can. But then you get the associated P&L of that larger stock position. And that's an important thing to think about. You are defining your risk, or you are capping your risk, or you are mitigating risk if and as you use options strategies as a substitute for a comparable amount of the shares. So if you could trade 100 shares of Broadcom and you could trade a one-lot call contract, then that's a more like-for-like comparison. So that's just an important distinction I would make. So when I hear people say, oh, well, I can use options in a smaller account to trade, larger portions of some of these high dollar stocks, that may be true. But understand that with that, you're going to be taking a significantly higher risk. And sometimes I will hear the amount of premium spent being conflated with a position in the stock. This is another reason why, and I'm not going to point the fingers, I'm not going to name names, but I have absolutely heard people say, oh, here are some trades that we did using options, and we made 300%, 400%, 500% returns, right? And here's what we would have made in the stock, and there's no comparison. So if we had bought the stock, we would be up 10%. But we bought some cheap out-of-the-money call option, and it quadrupled. So therefore, we made a 300% profit. That is not reasonable. That is not like for like. And my phone is chiming. Let me mute it and make sure this isn't something totally critical. All right. Well, I'm going to shut that off. Okay. So as much as anybody, I encourage the use of options. But I don't encourage the use of options in that way, which is that, with a limited amount of capital. I was just talking to somebody yesterday, in fact, who was trading options on levered ETFs. And when I asked why they were doing this, the answer was, well, because I don't have enough capital to trade it, by selling options premium. And this is a very confusing concept to me, because just because you don't feel like you can get the kinds of profits that you would like with the amount of capital that you have does not mean that you go off and do low probability, inadvisable, high risk bets. But yet that's what a lot of people do. You can make a lot more money in one night in Las Vegas with a certain amount of capital than you can probably make in one trading day with that same amount of capital. Just trading stocks, leaving options out of it. But that does not mean that that's what you should do with your capital, because that casino mentality has a very familiar and common outcome, and it's not pretty. Okay, so FinWest, good morning, Mike. Good morning to you. James Warburton, hail, Mike. The great Karnak sees all and knows all. Rivian 2. Could you use candlestick charts so we can better see the price range? Thanks. Yeah, that's a good idea. There is, oops. So my Bloomberg is logging me out. What you may or may not know is that with a Bloomberg terminal, it wants to, and it's not, it says express login, but it's logged me out already. Okay, so I'm going to have to bring that back. All right. So this thing needs to, once every 24 hours, it has to verify your identity. So there's a little biometric scanner here. And so it makes me re-log in at least once every 24 hours. The idea is that I can't just log on, then go on a 3-week vacation and let somebody else use it while I'm gone. So, oops, better kill that. You know what I'm going to do? Hang on one second. Apologize for this. Just need to... Oh, it looks like our savvy producer had already gotten rid of my screen share momentarily. But the Bloomberg machine is also used as a messaging device. Some people have referred to this as the most expensive instant messenger in the world, because a lot of people who are trading use Bloomberg, Instant Bloomberg, as they call it, IB chat, to communicate with one another. So Finwest, you were asking if I could use candlesticks. I can. This should give us that. There we go. So maybe that is helpful. I'll just do a 6-month chart here. It's a 6-month chart of Rivian. Maybe this will give you guys a better sense of whether, and you know what, I'm going to just put the 150 in here because that's what I've been using, so probably clean things up a little bit like that. You can see there was a big uptick in volume, blew through the 150, and there we are. Okay, so yeah, you can get a sense of what the range was there. All right, Tucker D. Dog, the Jade Lizard. Yes, that is what that strategy was when you sell a strangle and buy an upside call to hedge. Boy, I'm just getting blown up over here. So, and actually, that's interesting. So, someone just said, this is a great article. Rivian is 10% of my portfolio at this point. Okay. So apparently somebody else likes it. If future for Rivian is bright, why not purchase call Leaps vertical on Leaps? Okay, so this is a good question, and I'll hopefully I can illustrate that in this particular instance, I think selling premium is my preferred approach, just because the implied volatility is so high. You could go out and purchase Leaps. You weren't specific about which ones you were interested in, but let's just go out. I mean, a Leap, the Januaries aren't really Leaps anymore. So Leaps were developed so that you could trade an option that had a long enough time to expiration that your participation in that would be considered a long-term capital gain. So really, in order to achieve that, at this point, that would have to be more than a year. You're really going out to SEP of 2027. And so the mid-market on the September 2027 17 strike calls is $5.50. All right, so 1/3 of the current stock price to buy an out-of-the-money call option. And I'm not really that crazy about that idea. Instead, I think it's kind of, I prefer just selling some premium and, chiseling away and collecting, in this case, you can get 5% every 6 weeks or so. So that's a very attractive rate of return. And if you get put the stock Now you own it, you can sell some upside calls against it or sell some upside call spreads against it. And that's probably the direction I would lean in. The reason I would lean in that direction is because I think that the combination of the high short interest, their partnership with Volkswagen, that at $21 billion market cap, that's very big relative to the legacy automakers compared to the business that they do. But, you know, in the technology space, it looks like they have a pretty good full self-driving product. And it's going to be a lot more compelling because the end-of-year cars and thereafter will be 3-sensor vehicles. This is something that Tesla has pushed back on. So Tesla uses cameras. They also have radar in Tesla. So it's, I guess, basically a two-sensor car. The Rivians are going to be a 3-sensor car. They're 2 sensors at the moment. They will be 3. The 3 are going to be cameras. I think they're going to have 7. Radar and LiDAR. And in any given circumstance, you know, some sensor types are superior to others. Now, Tesla has made the point, and it's a reasonable one, I suppose, that humans drive cars and humans don't have LiDAR, humans don't have radar. Partially true. We do have radar nowadays, which is that most cars have some anti-collision systems built in. Many of them have radar. It actually annoys the heck out of me. My car slammed on the brakes when I was aware of what was in front of me. I live in a very hilly area with very narrow roads. There's a lot of bikers around here. The bikers sometimes feel like they own the road, but I was slowly making my way up this hill, and in order to get around some bikers, I had to wait for some traffic passing this way to go. And what I wanted to do was accelerate and then cross the line to give the bikers ample room, because when they're going uphill, they're leaning this way, they're leaning that way, got to give them a lot of room. Anyway, I started to accelerate. The car, not knowing my intent at all, you know, saw the bikers. I was not near the bikers, but it applied full braking force. Literally just threw me and my passenger into our belts. And it's a miracle I was not rear-ended, because every car behind me was planning on doing exactly the same thing. And there's no way that they expected me to hammer the brakes with full force. But I guess my version of this is that I think the Rivian is going to have a very compelling autonomous driving feature based on how good it is now and the fact that they're going to have more sensors in the vehicles by the end of the year. We'll see how regulators treat this, because, you know, one of the things we know about the safety regulatory complex for automobiles is that, you know, regulators are happy to introduce mandates for technologies that exist. So once somebody starts to use it, they're going to say, well, if they can use it, everybody can. And sometimes they are asking for things that aren't even out there yet. Sometimes some of these ideas are pretty far-fetched because legislators don't really bother to understand the, you know, the technical realities of this. Anyhow. Okay. Mike, Stephen asks, do you have any thoughts on Oracle? It's getting cheap, and Larry Ellison seems to have a lot of tricks up his sleeve, but I'm worried about catching a falling knife. I do have thoughts about Oracle. And it's interesting, because as soon as you asked me the question, it reminded me that I had actually texted with a friend of mine a week ago who has a family member that's on the board at Oracle. Larry Ellison certainly has done some remarkable things. This is what I'm not crazy about. And it's right down here. Right at the bottom. This is massive negative free cash flow, and this is chunky debt. Just to put things in perspective, you're talking about $80 billion in net debt just over these 2 years at their anticipated negative free cash flow. Now, you might say to yourself, well, Mike, you're talking about Rivian, and Rivian has negative free cash flow. It does. Their negative free cash flow is, obviously considerably smaller. We're talking about $1 to $1.2 billion a quarter. The company is smaller still. It's a $21 billion company, not a $400 billion one. But, my attitude about this is that if you think this investment makes sense, and you think that there are companies that are going to be positioned to capitalize on it, and there are some companies that might end up getting squeezed, Oracle is kind of going to be in the crosshairs of other big hyperscalers. They just don't have the operating free cash flow to compete with Alphabet and Microsoft and the likes, who are doing the same thing, Amazon. If these investments prove to be overambitious, that is not a huge problem for Alphabet, Amazon, or Microsoft to absorb. To a lesser extent, Meta. Meta is taking on some debt to do this. They are also talking about doing a secondary, it should be said, on the equity side. But these are companies that have such massive free cash flow that, let's just say that these companies all find themselves in a price war, that they end up offering similar services and competing with one another. The companies that otherwise are generating massive amounts of free cash flow are going to be in a very favorable negotiating position when it comes to pricing, relative to a company like Oracle, which has been seeing its debt go up. Look, it's almost doubled its debt over the course of the last 3.5 years. And it is poised to add another $80 billion over the course of the next, we'll call it 20 months or so at the current run rate. That's okay, but it is definitely more speculative. So for that reason, I'm not crazy about it. There's something else, which is that Larry Ellison, obviously tremendous entrepreneur, very shrewd guy. He is getting up there. Other members of his family seem to be more interested in other businesses, like Hollywood, right? So we can see that his son, supported by his dad's considerable riches, is trying to make himself a player in Hollywood. And, to me, I'm not crazy about that either. Not because that's Oracle's money per se, but just because I want the people, Satya Nadella is not distracted away from Microsoft's activities based on, the ambitions of a son who wants to make a name for himself in a completely different industry that has a lot of wreckage by the side of it. So I don't know. That's just my 2 cents. I will say that every company begins to look interesting at some level, and I don't know that we have quite reached that level yet. I would keep my eye on the technicals, but the best performing ones right now are decidedly also a little negative here, right? So Bollingers have served pretty well over the course of the last year. Trading envelopes, moving average envelopes. These things are all, exponential moving averages. All of these things have some elements in common, so it's not surprising to see that those technical indicators are generally in alignment. Most of them, though, you can see would lean short. And, I think there will probably be other opportunities. And we're bouncing right along. Let's see here. Let's draw a line and see whether there's something profound at the current level. Yeah, it has traded lower. I can see why this might appeal to your eye, right? It broke out from this level back in 2024, retreated briefly below it, right in here during the tariff tantrum business, and it has bounced off this level a couple times before. So is it reasonable to say, perhaps it could again? Yeah. I can see what your eye sees as well. But, you know, from a fundamental standpoint, you know, it's the same reason I was hoping that Rivian would do a secondary rather than issue debt. And that was that, you know, if you end up finding yourself in a bit of a pickle, debt can be a little bit more unforgiving. Actually, speaking of which, let's just sort of see where the debt is right now for Oracle. Now let's take a look at these. Trip B. Nope. So this is how the debt's looking. I mean, it is still investment grade. I mean, maybe for a bounce, I guess. Just off that trend that you know, this line right here. And let's see, do we have enough? Let's take a look at their calendar, see what we have. So we do have a couple catalysts. They're a late reporter, so we're not going to be hearing from them for a little bit. But we have this conference. It looks like they're participants next week. Let's see how. One other thing I would say is that this is a situation where, as the company adds debt, the options premium is going to increase, and that is because the equity is becoming more levered. This is a concept we have discussed before here. So, with all of the associated caveats that I have already provided, a couple of ways that one might consider playing it so that you can capture both the upcoming earnings, which, by the way, will help support the premium even through interim catalysts in the event that you decide to bail out on the trade sometime between now and then. A call spread would be one way to do it, whereas something like a call spread risky might be another way. Let's take a look first at what a call spread risk reversal going out that length of time for even would subject you to from a risk perspective. So I need to get, what can I sell for about 12-ish bucks? This is really not as far out of the money as one would hope. Let's see. So maybe try to sell the 120 puts. Going to have to bump this up a little bit. Take the 145 calls, 145.75, something like that. That's fairly close to even. Something like that. Downside risk is you own it around $1.20, which, if we go back in time a little bit, so let's just take a look at that other chart we had. And see what 120 looks like as an area where one might potentially get long. I'll go back to 2023 again and draw a line at 120 and see where that gets us. That's over here, right there, which also corresponds with this low. So that would be a way to do it rather than reaching out and buying the stock. So what have we done? We have identified a spot that seems intriguing potentially because it does look like it has sort of found some measure of support at this level from whence it broke out. I don't know. It looks like it might have actually violated that, but it did before as well. You know, something like that, 120, 45, 75 call spread risky. It'll probably have a little bit of decay in it. And then trade around it a bit, or work your way in. Right? That would be a way to do it. So how do you work your way in? Buy the 145 calls and SEP. If the stock rallies, sell the 175 calls against it as it goes higher. If the stock continues to fall, let it do a little bit more damage and then sell the 120 puts. So that's the way people can leg their way into some of these three-legged trades. You don't have to put the whole thing on at once. And when you do that around a long option, that's effectively, in a way, it's kind of like trading the gamma that option provides, right? So that would be a way that I would consider it. I will say that if you, like me, believe that there's maybe some overexuberance on the investment side in the AI space, the companies that are reaching a little bit more in the way that Oracle is, borrowing a little bit more than they're maybe otherwise comfortable with, to try to remain competitive with some very well-heeled companies, the best and most profitable companies on Earth, it's difficult to be and also ran. But the other interesting thing is that none of those stocks have had quite the pullback that Oracle has. So, talking out of both sides of my mouth, but that's kind of my thinking. Okay. All right. Dinwest says, I think the candlesticks paint a better picture of price action. Thank you. Yeah, I agree. Sometimes I do like using a simple chart, kind of a 30,000 foot view. Very often you will see, Carter Worth will do that on CNBC. But you will also notice, if you've ever seen some of the videos that he does outside of CNBC, that he's much more likely to use candlesticks. He's much more likely to use a chart that looks like this one. It's just that in that context, when you're doing a screen share and a video presentation like this, sometimes that's a little bit too granular. Michael Anthony, how are you? Let's take a look. You have Levi Strauss in here, the company from whence the mayor of the city closest to me made his money. If you guys don't know, the current mayor of San Francisco, Daniel Lurie, is a Levi Strauss heir. Admittedly, I have not really looked at this company of late. Price action, at least on that chart, looks all right. Let's take a look at the fundamentals. Respectable top-line growth, meets my criteria that many of you will know. As fast or faster than the economy and, probably the real rate of inflation. Earnings per share growth, also reasonable. And faster than revenue growth, that's a good thing. Free cash flow yield, looks like they expect it to decline next year. That's not great, but let's just assume that the full year free cash flow estimates are correct over the enterprise value, 5.4%. That is also pretty good. And I'll give it the benefit of the doubt. And actually, I'm going to split the difference. I'm going to say that I'll handicap next year's numbers. And I'm going to say that they do $1.60 in EPS. That puts them at 15 times forward earnings with a 5.4% free cash flow yield. And that would not work out to a 12% growth rate year on year, because that's based on a slightly higher number, but that's still better than 10. So, call it 10. Let's just say 10% adjusted EPS growth, 5% free cash flow yield, 5% top line growth, and trading at 15 times. That seems reasonable. So that's where I'm at. On the fundamentals. Let's take a look at volatility in the event that somebody's interested in trading options on this sucker. You can see the earnings vol baked into this cake a little bit here. You get a pretty good vol crush coming out. Kind of moves what we've been seeing. Seven 7% average earnings related move. The last 3 of the last 4 quarters have seen double digits though, so this thing has whipped around a pretty good bit. Implied move of 8%. Other numbers come out here. We got 19 cents. The estimate was 24.5, but this number is saying that's positive. Why? So there must be some adjustments in these numbers, just so you know. Yeah, so this comp figure, this is the number that you're trying to look at, right? So this is what they reported. This is an adjusted figure that is the way you relate the reported number to the number that was in the estimate. So this should work out that 28 cents a share is 14.3% better than 24.5. And we can verify that. And indeed it is exactly right. So it's probably some non-GAAP figures that are getting baked into this cake. But it would seem reasonable. Now let's take a look at some of the technical indicators here. Well, the best performing ones don't like it. Let's take a look at why and where they would have leaned short. Well, that has not been so great. So it looks like, oh no, here. So it got short. I was covering this up. So it got long here and short there. Yeah, not terrific. Let's go back and see. These other, the next 2 are very similar types of indicators. Buy and hold, we're going to leave that out. So let's take a look at weighted moving average. What is that one doing? Okay. Yeah, I mean, look, from a fundamental standpoint, I think it looks intact to me. I mean, I think if it's above 25, it's probably out of the near-term technical woods, would be my take on that. FinWest, I sold some puts on Pepsi for its earnings tomorrow. We probably, I'm going to guess, we have a position in Quad D. Let me see. Which is not short puts, but, you know, if you're long stock and short call spreads. Let's see, do we? Yep. So, yeah, as expected, we are long Pepsi. Oh, you want, no, and you know what? You just mentioned it, so you like the candles, so let's do that. This does look like this is a little bit tricky on the long-term moving average front. Not great, but you're selling puts, you're not buying calls, so that's all right. Let's see what the other technicals are giving us. A mixed bag. Probably not implying a very big move because this thing barely, these staple stocks, I mean, consumer names, I'm going to call this a staple stock. Not that Pepsi should be a consumer staple, but like toilet paper, but I suppose it is. Yeah, I mean, it averages a 2% move, so it's only implying 3.3. But I think that's fine. We can kind of see even here, if you're just taking a look at how the company has behaved, it's just sort of goes along like a metronome. Michael Anthony, I own Pepsi and shouldn't. I own Pepsi that millions of people drink soda and eat chips will grill burgers and hot dogs on July 4th weekend. Well, July 4th weekend is over, but I have a feeling that soda, chips, burgers, and hot dogs are not. I'm sure there's going to be a lot more of all of the above consumed between now and Labor Day, and probably for some, well beyond. Wouldn't even mind some burgers for dinner myself. So you're asking me, do I think Pepsi will beat? I will be honest, I haven't really given it that much thought. You know, as you can see, I get fairly preoccupied by some companies, and others don't gather and attract quite as much attention from me. I think Pepsi falls into this category, and one of the reasons it falls into the category has actually less to do with what I think their operating performance is going to look like, and more to do with the fact that I anticipate them to kind of just grind away and do their thing. And so I'm not really expecting any big blockbuster numbers coming out when they report, and consequently I tend to look at that as a little bit less of a catalyst just because the stock doesn't move that much. You know, Rivian moved almost 20% yesterday, and that was not earnings. And Pepsi moves less than 2% on average when they do report earnings. So, you know, I don't spend a whole lot of time thinking about it, but I will say that if you're going to look at the company, these are the numbers that you probably should be focusing on, which is that, you know, does the trend remain intact? Is the growth rate, so the growth rate, as you guys will know, that's the numbers up here. We like to see this number, which is the year-on-year percentage growth. They should probably put a percent like that so you can tell. But I'd like to see that at 3% plus, because I'm assuming that GDP growth is going to be north of 3%. I'm assuming that inflation will be north of 3%. And if they're not growing at least at that rate, that means that they're shrinking in real terms. The expected number is for 5.2% year-on-year for the full year. And, you know, frankly, for a company like this, that's actually quite good. Also quite good are these numbers. 7.5% adjusted EPS growth year-on-year anticipated for this year, and 5.7% for next. Those are solid numbers, as are these numbers. And I'm just going to take some average, even if I just call it 10, right? So, you know, 4.5%, so 4 to 4.5% annualized free cash flow growth with a decent growth rate in anticipated free cash flow. And this is the nominal number. So sometimes when you look at the adjusted EPS growth, that's 9% anticipated year-on-year free cash flow growth. And that's the gross free cash flow number. So the adjusted EPS number, and I don't know if I mention this all the time. Sometimes I might think of it, or just in the context of the conversation, I do not. The thing you need to pay attention to when you look at the adjusted EPS growth is how much of the adjusted EPS growth is organic, you know, corporate growth versus per share adjusted EPS growth that is a function of accretive activities like buybacks. So, you know, this company has a good amount of free cash flow, so of course they're going to have a buyback, and they've got a pretty big one. You know, they've got almost the entire amount of their most recently reported buyback remains, which is 5% of the outstanding shares. So that's another reason why these stocks will tend to be stable. They've got a lot of free cash, and they buy back a lot of stock, and this one's buying back a lot of stock. But as we saw, the top line numbers, we are seeing better than 3% growth there. So if that was like a 1% number, shrinking in real terms, but adjusted EPS is growing up by 5 to 6, all as a function of buybacks, you know, you don't want to pay huge multiples for a company like that because it's not growing in real terms. But this one seems to be holding its own, so I'm fine with it. James Forbin, are GLP drugs shrinking the Are they shrinking the margins like Pepsi? So this is an interesting question. GLP-1s are being widely distributed. Supposedly, I haven't taken GLP-1s myself, but what I hear is that they significantly curb the appetite for things like this, because it curbs your appetite for carbs, curbs your appetite for sugar, curbs your appetite for alcohol. In fact, I think that some of these things have actually been used as a partial treatment for people that suffer from alcohol abuse. And you would think that if what your business was selling soda and chips, and a very popular new drug is coming on the scene and helping an overweight population where a significant percentage suffer from obesity, wean their way off of your product, that's not great. But the financials here are not indicating that, at least not this year or next. That doesn't seem to be what's baked into the cake for consensus. So, who knows? I could stand to lose a few pounds. Maybe I should try out GLP-1s, although I've heard things like you can increase interocular pressure and some other stuff. I always feel like there's no free lunches. You know, it's one of these things that if you've been a trader a long time, your inclination is to distrust any arbitrage. What's an arbitrage? It's a risk-free bet. So if I can make a bet on something and I cannot lose money, but it has the possibility of making money, that's an arbitrage. And the way some of these drugs are being sold, it's as if it's an arbitrage. You know, you can take this pill and you will magically lose weight. But, you know, wasn't that also the case with fen-phen? You know, and then it turns out that it can cause heart valve problems. And then they had, I can't remember what it was, they had a food additive when they thought that it was like a fat substitute. That was back when they thought fat rather than sugar was the big culprit in obesity. I want to say Olestra, maybe? Maybe somebody here will remember what the additive was, but that also had some fairly nasty side effects. Anyway, I'll let you guys research what those side effects were if I remember the name of the additive Olestra correctly. And I think we will leave it there, in part because that's as good a place as any to sign off, in part because I have taken up more than a valuable hour of your time, for which I am truly grateful. Every time you guys tune in, like, subscribe, notification bell, all that good stuff. Keep your comments coming. But also because I'm about to be joining another video, which starts very soon. So until next week, thank you all for watching, and we'll see you here.